Welcome to the Divorce the IRS Podcast, the retirement income planning podcast designed specifically for those who want to pay the least amount of taxes possible and build a retirement income that lasts. Inspired by the best-selling book, Divorce the IRS, you get to go behind the scenes with financial planner, author, and speaker Jimmy Miller. Learn how to set yourself up to pay the least amount of taxes in retirement when you'll need your money the most. And now, here's your host, Jimmy Miller.
Welcome to episode 6 of the Divorce the IRS Podcast. Today, we're going to ask, are you borrowing money from the IRS? And we're going to explore the idea that the tax deductions you're enjoying when putting money into tax-deferred accounts, like your IRA and 401k at work, are really not tax deductions, but are more like small loans that the IRS is giving you now and will collect on later. In the last episode, we explored the concept of the 3 tax buckets that all account types fit into. They were the tax me now bucket, the tax me later bucket, and the tax me never bucket. We also discussed that most people are using the tax me later bucket as their primary bucket for retirement savings, and that maybe it isn't the best idea. Let's flesh that out in more detail today. Are you contributing to a tax-deferred plan or a tax me later account like a traditional IRA or 401k as a way to save for retirement? Well, if you are, you're not alone, as millions of Americans do this every payday. These types of accounts are by far the most popular ones Americans use to save for retirement. But that doesn't make them the best choice in all circumstances, though. If you didn't realize that those tax deductions are really just a loan from the IRS, and you don't want to be borrowing from the IRS and have the burden of a tax lien on your retirement accounts in the future, keep listening. Here's a secret. Those tax deductions you take today aren't truly deductions. They're an advance on your retirement savings that you'll repay someday, and then some. In short, it's basically a loan you take from the IRS each pay period that you'll have to repay when you retire, a time in your life when you need the most money possible. Let's take a look at a quick example to explain. When you contribute $100 from your paycheck into your IRA or traditional 401k plan, it goes in pre-tax, and you aren't really saving a full $100. Since the $100 is pre-tax money, it was never all yours to begin with. The IRS was always going to take its tax from that pay. It was just a matter of when. But by putting the $100 into your traditional 401k, the IRS has given you a pass on paying that tax, for now. By giving you a tax deduction this year, the IRS instantly has a lien on that $100 for all the taxes you will owe on it one day, at whatever the tax rates will be when you take it out. Now, for simplicity, let's just assume you're in a 20% tax bracket. When you save that $100 into your 401k pre-tax, you reduce your taxes for that pay period by $20. That's an extra $20 in your pocket for you to spend. But what you really did was save $80 of that $100 and took a small loan of $20 from the IRS that you'll have to repay back later in life. And later, when you take out your $100 during retirement, or before, should life throw you a curveball along the way, you will owe back the tax deduction or loan, and probably more if you consider the growth. See, if your $100 grows to $200, you will owe taxes on twice the amount of your original deduction, the full $200. If you're still in that 20% tax bracket, you will now owe $40 of tax to take that money out. That's like paying interest on the small $20 loan you originally took. Even if your marginal tax bracket has dropped by 25% and you're now only in a 15% tax bracket when you take out the $200, you will still owe $30 in tax when you only got $20 as a deduction on the original contribution. And if your $100 has grown to more than $200, this gets even worse for you, but great for the IRS. Understanding the tax deductions on your retirement money are a loan from the IRS offers you an easy way to boost your retirement savings. And this is great news, as it's no secret that Americans aren't so good at saving for the future. In fact, we have one of the lowest savings rates in the world compared to other developed countries. So let's look at how you can boost your savings by making a simple change to something you're probably already doing, contributing to your 401k at work. More than 90% of retirement plans in America now offer the Roth 401k option, yet very few people contribute to it. There are a couple of reasons for this. First, the Roth option hasn't been around that long compared to the traditional 401k option. Roth was introduced in 1997, but it wasn't until recently that many employers added the Roth option to their workplace retirement plans. Second, when it was added to the plans, most people didn't bother to switch their contributions over to it. And this could be because they were lazy and thought it was too much hassle, or they didn't understand the choice, or they didn't think it would benefit them to switch. From my experience in working with savers over the years, I find that the latter is usually the case. People didn't fully understand the benefits of tax-free growth and instead opted to continue receiving the tax deductions or loans from the IRS. They believed it would be better to take the deductions now and maybe pay them back later in life when they thought they might be in a lower tax bracket. And we'll explore why this is a myth in an upcoming episode. So, one reason you should consider switching to the Roth option is because it's the easiest way to boost your retirement savings and help out future you. Some worry that by stopping the contributions to their traditional 401k or switching to the Roth option, they will lose out on tax deductions. And this is true, but you have to remember, the point of your retirement account is not to give you a tax deduction. It's to maximize your income at a point in life when you need your money the most, in retirement. By switching to the Roth 401k option, you will be saving the full $100 every pay period towards your future, and the money will be tax-free, not just tax-deferred. It's true that the money you take home today in each paycheck will decrease by the $20 you were borrowing from the IRS, but wouldn't you rather sacrifice that meager $20 now, which you're probably blowing anyway, and have a retirement account that's all yours one day instead of partially owned by the IRS? Now, some would argue that if you use the traditional plan and save the tax deduction as well, you could have even more money down the road by utilizing tax-deferred accounts. And this is true in certain circumstances, but the problem with this argument is that in the 25 years I've been helping people save, I've never met anyone who actually saves the tax deduction they receive each pay period. I mean, do you calculate this out and put the money aside every 2 weeks? You probably don't. Nobody really does, which is why it's not an effective strategy. When you instead switch your contributions to the Roth 401k, you put away the money you were receiving as a tax deduction and you save the whole $100. It's easy and it's all done for you. The argument of claiming the tax deduction also doesn't take into account the tax consequences of where you might save that extra money or deduction if you actually did save it. You'd have to save that money in your Tax Me Now bucket, like a brokerage, a mutual fund, or a bank account. And by doing that, you create other tax problems, as you will learn later in future episodes of this podcast. Now, if you don't have access to a Roth 401k option at work, consider lowering the contributions to your traditional 401k to the minimum amount required to receive your company match, if there is one. Many employers will match or contribute extra money to your workplace retirement plan if you contribute a certain amount, usually a percentage of your salary. The match is free money from your employer, so you should take advantage of it. And recent legislation should also start allowing employees the option of how they would like their match contributions invested as well, either pre-tax or after-tax Roth. And this is great news for those who want to divorce the IRS one day. Next, you should contribute to a regular personal Roth beyond the amount that is matched in your 401k. In 2026, this is $7,500 for those under 50 years old and $8,500 for those 50 and over. If you're still able to save more after you've maxed out this account, consider a regular brokerage account or the Mega Backdoor Roth strategy, which we'll discuss in detail in future episodes. If you really have a lot to save, you can also consider a life insurance retirement plan, or LIRP for short, which is also discussed in a future episode. Also, it's important to have some money in the tax-deferred bucket upon reaching retirement so you can take advantage of your standard deduction. And we'll explore all the reasons why and how much you should have, which is called your ideal number, in this bucket in a future episode as well. If you don't want to borrow from the IRS each pay period and create a tax lien on your future, consider shifting more of your savings to the tax-free bucket, using strategies we will discuss in upcoming episodes. If you don't have an adequate emergency fund already, shift your savings to meet this goal first. And once accomplished, pay off any high-interest debt or credit cards before shifting to tax-free savings. When you contribute to this bucket, the Tax Me Never bucket, you will be saving the full contribution, and the IRS won't have a lien on your retirement. You will also avoid falling victim to one of this country's biggest crimes against young people, which we're going to discuss in the next episode. See you there.
Want even more ideas, tools, and resources on how to navigate your financial life? Check out all the resources on the Divorce the IRS website at divorce-the-irs.com or the Baobab Wealth website at baobabwealth.com, and subscribe to the blog to stay up to date on issues affecting retirement income planning. Don't forget to subscribe to the podcast so you never miss an episode. Baobab Wealth and Baobab Wealth Abroad are DBAs of Baobab Wealth LLC, a Florida registered investment advisor. This podcast is designed for general education purposes only and shouldn't be taken as legal, investment, or tax advice. You should seek out a qualified tax professional or licensed financial advisor to determine what is best for your personal situation.